Good day, everyone. I am Phil Ambi Pacania, the 7th reporter, and I am going to discuss the types of controls. Firstly, controls can be established to focus on actual performance results, which is the output, the activities that generate the performance, which is the behavior, or on resources that are used in performance, which is the input. It means that controls are used to attain the stated goals or objectives in a desired manner, specifically in an organization. The following are the three types of controls: output controls, behavior controls, and input controls. Output controls specify what is to be accomplished by focusing on the end results of the behaviors through the use of objectives and performance targets or milestones. Output controls emphasize targets and enable managers to use processes or means to achieve these targets. These allow flexibility and encourage creativity within the organization. Some examples of output controls are sales quotas, specific cost reduction or profit objectives, and surveys of customer satisfaction. Next is behavior controls. Behavior controls specify how something is to be done through policies, rules, standard operating procedures, and orders from a superior. Behavior controls are necessary for ensuring appropriate behavior from employees. They encourage behavior that will ensure that goals are met. These act as control systems that allow the managers to shape and motivate employee behavior. Some examples of behavior controls are following company procedures, making sales calls to potential customers, and getting to work on time. Then, input controls. Input controls emphasize resources such as knowledge, skills, abilities, values, and motives of employees. Some examples of input controls are job requirements such as education level, example, high school diploma versus master's degree, years of experience in similar work, language spoken, writing, and communication skill level. The goal of input controls is to avoid the unexpected. Examples of increasingly popular behavior controls are the ISO 9000 and 14000 standard series in quality and environmental assurance. It is developed by the International Standards Association of Geneva, Switzerland. The primary objective of the ISO 14000 series of standards is to promote effective environmental management systems in organizations. The standards seek to provide cost-effective tools that make use of best practices for organizing and applying information about environmental management. The ISO 14000 family was developed in response to a recognized industry need for standardization. With different organizational approaches to environmental management, comparisons of systems and collaborations had proved difficult. Using the ISO 14000 standard series is a way to document the company's impact on the environment. ISO 9000 is defined as a set of international standards in quality management and quality assurance developed to help companies effectively document the quality system elements needed to maintain an efficient quality system. They are not specific to any one industry and can be applied to organizations of any size. ISO 9000 can help a company satisfy its customers, meet regulatory requirements, and achieve continual improvement. It should be considered to be a first step or the base level of a quality system. Using the ISO 9000 standard series, which is composed of 5 sections from 9000 to 9004, is a way of objectively documenting a company's high level of quality operations. Many corporations view ISO 9000 certification as assurance that a supplier sells quality products. Firms such as DuPont, Hewlett-Packard, and 3M have facilities registered to ISO standards. Companies in more than 60 countries, including Canada, Mexico, Japan, the United States, including the entire US auto industry, and the European Union, require ISO 9000 certification of their suppliers. These types of controls are organizational control system that allows executives to track how well the organization is performing, identify areas of concern, and then take action to address that concerns. Then next is activity-based costing. Activity-based costing, or ABC, is a recently developed accounting method for allocating indirect and fixed costs to individual products or product lines based on the value-added activities going into that product. Before the activity-based costing was developed, the traditional cost accounting was used. Traditional costing is the allocation of factory overhead to products based on the volume of production resources consumed. Under this method, overhead is usually applied based on either the amount of direct labor hours consumed or machine hours used. The trouble with traditional costing is that factory overhead may be much higher than the basis of allocation, so that a small change in the volume of resources consumed triggers a massive change in the amount of overhead applied. This is a particularly common issue in the highly automated production environments, where factory overhead is quite large and direct labor is close to non-existent. For example, a traditional costing calculation might find that factory overhead should be charged to products at the rate of $500 per direct labor hour. So, if there is a slight change in the production process that increases direct labor by 1 hour, the cost of product has just increased by $500 of overhead. Such a large change in applied overhead is non-ethical, since there is not always a direct relationship between the volume of production resources and factory overhead. Activity-based costing is a methodology for more precisely allocating overhead costs by assigning them to activities. Once costs are assigned to activities, the cost can be assigned to the cost objects that use to those activities. The system can be employed for the targeted reduction of overhead cost. ABC works best in complex environments where there are many machines and products and tangled processes that are not easy to sort out. Conversely, it is of less use in a streamlined environment where production processes are abbreviated. Activity-based costing provides a more accurate method of product or service costing, leading to more accurate pricing decisions. It increases understanding of overheads and cost drivers, and makes costly and non-value-adding activities more visible, allowing managers to reduce or eliminate them. ABC enables effective challenge of operating cost to find better ways of allocating and eliminating overheads. It also enables improved product and customer profitability analysis. It supports performance management techniques such as continuous improvement and scorecards. An example is the Coca-Cola industry. Coca-Cola is another company that uses activity-based costing to determine its price points. Coca-Cola offers a large portfolio of products and carries a huge amount of inventory, which can be a significant portion of production costs that is often overlooked. Coca-Cola has used activity-based costing to evaluate the differences between its bigger worldwide products and its specialty, regionalized products that it may not offer on the global market. This understanding of how production costs are different between established, familiar types and specialized types has enabled them to set price points in each market that ensure them significant profit. Now, Let us know the differences between traditional costing versus activity-based costing. In the traditional costing system, direct and indirect costs are allocated to process centers or major departments, while in the ABC system, the direct and indirect costs are allocated to activities like purchases, material handling, producing the goods, machine setups, supervising production workers, inspecting finished goods, dispatching goods to customers. The cost driver in the traditional costing system, as base for allocations of overheads, is not based on cause and effect relationship. While in the ABC system, cost driver as base for allocation of overheads is based on cause and effect relationship between overheads and the overheads allocation base. Then lastly, in the traditional costing system, there is only one cost driver or overhead allocation. While in the ABC system, there are many allocation bases as per activity chosen and cause and effect based relationship. Let's move on to enterprise risk management. Enterprise risk management, or ERM, is a corporate-wide integrated process for managing the uncertainties that could negatively or positively influence the achievement of the corporation's objectives. Enterprise risk management is a plan-based business strategy that aims to identify, assess, and prepare for any dangers, hazards, and other potentials for disaster, both physical and figurative, that may interfere with an organization's operations and objectives. Before, managing risk is done in a fragmented approach, leading to a huge risk faced by an organization. ERM is being adopted because of the increasing amount of environmental uncertainty that can affect an entire corporation. The following are the phases of rating risk. First, identify the risk using scenario analysis or brainstorming or by performing risk self-assessments. Using brainstorming as a risk identification technique provides a free and open approach that encourages everyone to participate. For a session to be effective, it's recommended that you have a defined project scope and that it happens before the first sprint planning. It is much less effective to organize the session later since you may lose the chance to avoid some problems early on. The commonly used risk tool shown is a 2x2 matrix that allows assigning a risk to one of four quadrants based on a qualitative assessment of its relative impact and the likelihood of its occurrence. We can see in the left side the likelihood of occurrence and in the bottom the relative impact. The 2x2 matrix shows that there is a low impact with low probability, high impact with high probability, low impact with high probability, and high impact with low probability. So the risks that can be characterized as both low impact and low likelihood of occurrence are essentially negligible and can usually be eliminated from active consideration. Then the risks that are characterized as both high impact and high likelihood of occurrence often cause a project to be terminated or to fail if it is continued in spite of the risk. The low impact with high probability risks are those largely due to uncertainties about a number of elements that may be individually minor risks but in the aggregate could amount to a significant risk. Then, by definition, high impact with low probability events are rare occurrences, and therefore it is very difficult to assign probabilities to them based in historical records. Some companies are using value at risk or VAR, effect of unlikely events in normal markets, and stress testing or effect of plausible events in abnormal markets, methodologies to measure the potential impact of the financial risks they face. Value at risk is a statistic that measures and quantifies the level of financial risk within a firm, portfolio, or position over a specific time frame. This metric is most commonly used by investment and commercial banks to determine the extent and occurrence ratio of potential losses in their institutional portfolios. For example, a risk manager determines that a company has a 5% one-year value at a risk of $10 million. This value indicates that there is a 5% chance that the firm could lose more than $10 million in a year. Given a 95% confidence interval, the maximum loss should not exceed $10 million over 1 year. Earnings at risk. Earnings at risk is also used by some other companies to measure the risk. Earnings at risk is the amount of change in net income due to changes in interest rates over a specified period. It helps investors and risk professionals understand the impact that a change in interest rates can make on companies' financial position and cash flow. Earnings at risk calculation includes balance sheet items that are considered sensitive to changes in interest rates and generate income or expense cash flows. For example, a bank may have 95% confidence that the deviation from expected earnings due to changes in interest rates will not exceed a certain number of dollars throughout a certain period. This is its earnings at risk. Enterprise risk management is important because its success determines the health and life of the business enterprise. If an organization fails to identify risk to its existence, it will be ill prepared to face any risk events. Next is the primary measures of corporate performance. Firstly, traditional financial measures that include return on investment or ROI, earnings per share EPS, and return on equity ROE. The most commonly used measure of corporate performance in terms of profits is return on investment or ROI. It is simply the result of dividing net income before taxes by the total amount invested in the company, typically measured by total assets. Here are the advantages and limitations of ROI. Advantages. ROI is a single comprehensive number that includes all revenues, costs, and expenses. It can be used to evaluate the performance of a general manager or a division of SBU. It can be compared across companies to see which firms are performing better. It provides an incentive to use current assets efficiently and to acquire new assets only when they would increase profits significantly. The limitations of ROI. ROI is very sensitive to depreciation policy. ROI can be increased by writing down the value of assets through accelerated depreciation. It can discourage investment in new facilities or the upgrading of old ones. Older plants with depreciated assets have an advantage over newer plants in earning of higher ROI. It provides an incentive for division managers to set transfer prices for goods unsold to other divisions as high as possible, and to lobby for corporate policy favoring in-house transfers over purchases from other firms. Managers tend to focus more on ROI in the short run over its use in the long run. This provides an incentive for goal displacement and other dysfunctional consequences. ROI is not comparable across industries, which operate under different conditions of favorability. It is influenced by overall economy and will tend to be higher in prosperity and lower in a recession. Although using ROI has several advantages, it also has several distinct limitations. Although ROI gives the impressions of objectivity and precision, it can be easily manipulated. Earnings per share, or EPS. which involves dividing net earnings by the amount of common stock. EPS also has several deficiencies as an evaluation of past and future performance. First, because alternative accounting principles are available, EPS can have several different but equally acceptable values, depending on the principle selected for its computation. Second, because EPS is based on accrual income, the conversion of income to cash can be near-term or delayed. Therefore, EPS does not consider the time value of money. Return on equity, or ROE, which involves dividing net income by total equity, also has limitations because it is also derived from accounting-based data. In addition, EPS and ROE are often unrelated to a company's stock price. The limitations of ROE includes it can be misleading in the case of new companies where the capital requirement is high in the initial days, resulting in lower ROE. Then, the ROE can be manipulated using various accounting caveats like increasing the project life, decreasing depreciation, and etc. Because of this and other limitations, ROI, EPS, and ROE are not by themselves adequate measures of corporate performance. At the same time, these traditional financial measures are very appropriate when used with complementary financial and non-financial measures. The other primary measures of corporate performance will be discussed by the next reporter.